Go across to our first guest now. Vinit Bolinjkar is now with us. Vinit, thanks so much for taking out time for us. What do you make of this last 4-5 days? Suddenly sentiments have turned. Markets have started to get, very risk averse. I mean, people are pricing in risk pretty fast. What do you make of these events in the last 7-8 days?
So, definitely the world's largest economy is having a kind of a very, very black swan event. And, with the Fed effectively coming in to backstop the FDIC, means that the entire deposit base of the USA is going to be, whatever run on banks happens out there is going to be funded by the Fed. So effectively, we are talking of another QE coming through. And when you link that with China dumping treasuries, it's not a very strong vote of confidence in the reserve currency. So there is going to be selling happening, and asset classes are selling off globally. And to that point, India is facing a little bit of pressure. Having said that, we are continue to trade above the long-term average of 17 time multiple in the Indian markets, and there is a possibility that we could drift down towards those levels. And 16,800 to 16,900 levels is where we think that the market might find support.
Right. One is about levels, one is about valuation. You think suddenly markets are looking in at very, very, a lot of risk being priced in? You think it's a classic risk-off sort of a sentiment that's visible?
See, we have to see one is the global meltdown that is happening. Okay, it is a kind of a 2008 sort of event. We can't say up to that extent because the action of the Fed has been pretty swift. But if you look at it, we are in India also. We are talking of a poor monsoon, and with poor monsoon, the wheat crop is also not as good as it is made out to be. So effectively, what we are talking is that rural recovery, which we were pricing in, is not going to play out as desired, and hence domestic as well as global issues, plus the threat of selling pressure in the Indian markets, is causing this sell-off to take place.
How would you approach this market? Is it time to buy the names that are tried and tested? Is it time to buy the names that essentially something you believe have done well?
So, as a strategy, one should be focusing more on domestic themes, number one. Number two, where, there is a lot of value in the stocks. So ideally, you should be looking for a portfolio which will give you growth plus value in the making. If you want to play a possible rebound happening, and focus should be more on the value stocks as such. So that should be the way you should be approaching this market and buying into them.
Would you go across on the defensive side of the market? Do you believe that defensive names like pharma, consumer companies can be bought at these levels now?
Definitely, we are quite bullish on the infrastructure space because action is going to continue irrelevant to the market because it's a nation building event. And here we like KC International is one company that we like. So we believe that the company's order book, which is standing at about close to 30,000 crores, it's actually 29,000 crores odd, 1.8 times revenues, 12-month revenues, and available at a reasonable PE. It's about 12.3 times FY25. While it has still run up immediately, one can look to add this stock on declines. Other stock that we like is a name which is not often, you'll find it on anyone's radar. We like PNG, hygiene and healthcare. So that stock is a FMCG stock with limited portfolio of products, but with very good present penetration levels and strong market share in the cough and cold category. So, it's a play on a little bit of pharma as well as on female hygiene. So we like this stock. So others which we like are Sundaram Fasteners. We like Bharat Dynamics, where, we have got a lot of visibility on revenue streams because, if you're going to build aircrafts and if you're going to take care of your defense interests, we are going to see a lot of orders come in, not only from the Indian Defense Forces, but also from global nations. So these are typical stories that we like. Another one that we like is NTPC, where it has got 71.6 gigawatt of portfolio, plus it is adding around 30,000 gigawatts of green energy. And with long-term PPS backed, cost plus pricing structure, I think their ROE recovery is going to be very strong. So these are some of the stocks that we are recommending to our clients to look at.
Right. In terms of, what should be the approach, I also meant to ask that, should more allocation be done towards equity, say if you are, having some allocation towards fixed income where rates are now on the higher side, or because the rate scenario is so strong in terms of 8, 9, 10%, one should also focus on those returns?
So, we have to take two, three things into consideration. With global liquidity also going to be on an upswing now because you have to backstop the crisis in the US. You are going to see global liquidity go up, and that is going to cause a lot of inflation. And with inflation around, fixed incomes are also set to rally. And given that, I believe that a sizable portion of your portfolio should be going towards your other asset classes which can give you an assured return. Right now, equities are a slightly uncertain, and hence, a portfolio which is focused more towards debt and fixed income with the rates going up should be a good portion of your portfolio.
Right. In terms of how would you look at the levels, you mentioned about 16,800 or 16,900. So at that level, what will be the sort of valuation that you would look at? And say if there is some amount of bad news coming in, something which again the market did not predict, then what sort of worst case valuation would you look at?
So, if you see over the long term, and even in 2008, when the market had tanked, we had gone to 12 times 1 year forward earnings. Uh, that is not to say that that is going to happen, but I think around 17 to 18 times earnings where we are trading right now, we will see good support emerge, and then maybe around 14 times earnings, or around 16,000 Nifty levels is where one can look to uh, add another tranche in case you think that the market is looking weak and is headed lower than the 16,800, 16,900 levels.
Right. Just, if you could give us, how would you approach companies? So, I mean, I'm talking about the style of the investment. There was a time in the last couple of years where people were looking at very high growth, very high capex. You think now time has come to focus on mediocre growth but good free cash flow?
Absolutely. Well, the free cash flow should always be your mantra. That should be the number one mantra if you're buying stocks. Second is, I would recommend investors to stay away from export businesses, which look at earnings coming, large part of the earnings coming in from overseas geographies, and be more focused towards India specific businesses, because India is a fairly insular market, and that is where the growth is going to come. So your portfolio should be uh, away from exports, domestic stories, strong value with growth initiatives. So that is the way we would be playing the markets.
Thanks so much for taking out time for us. Always good to get perspective from you. That's a perspective coming in from Vinit about markets, how to approach and how to change the style of investment if the need be. In fact,